Well, the last session of the morning session is about to begin, and there's because of the high interest in the topics, we continue to keep rolling it forward, but there's a limit on this one because lunch is going to be on at 12:30 in the afternoon. So, 12:30. It's still 12:30. So, it's we've got an hour, and theoretically, this is to allow us the time for the 15 minutes. We've got a little 3 more minutes on top of that one for the 45-minute discussion and the question and answer. And it appears that what we're going to do is sort of roll forward the continuation of where Tom left us, not in the lurch, but right on the edge of the basis. And then there will be a dialogue with we'll continue forward with this and play this one out. So, Tom?
Maybe what I was thinking is, because I know there's still some questions left, so let's maybe just finish the questions on this, and then, we'll talk about a few things. So, let's go with the next.
Tom, what's magic about the 4%? Interest rate.
What's magic about the 4% is that, I heard someone part of that, there's lease rate, but in fact the interest rate, that one component of the carrying cost of almost anything is the cost of financing it. So if you buy gold for the purpose of trading the basis or doing anything else, you have foregone being in cash and investing that, for interest with a bond or CD or whatever it was. And obviously gold is the ultimate risk-free asset, so you might expect that its interest rate would be the lowest. But nonetheless, that would be the main component. But it's also interesting that typically you wouldn't see this, like if interest rates are at 8-9%, this number doesn't really go up quite that high. It could go to 6, let's say. And this 4% is not any more magic than this has been a number that has been consistent over the last few months and few years.
So the 10-year bond is getting up towards 4%. If it got up, as I expect, maybe 10%, you'd expect that to go to 6 or 7, something like that?
Well, it depends on, what the spot demand for gold is. If the bond is going up because people are selling the bond and they're trying to move further up or down the Exeter's pyramid, becoming less risky, that means going into gold, that means this would actually be lower. So it's not necessarily true that this is a direct relationship to the interest rates, but when I was saying that 4% tends to be a top, what I was saying is that the natural limit of that, I think I described a couple of days ago, sort of if you can buy it and then store it, for less than what you can sell it for, that you make a profit. But really there is that interest rate component to it too that you have to consider. But it's not an exact relationship.
During 1999 and 2000, when the gold price was at relatively low levels, what was the interest rate at that point in time as a basis? Was it high?
What was the interest rate? What was the interest rate in 1999, 2000? That was probably pretty similar to today, wasn't it?
It was about 2%.
Yeah, for the target rate, but bond rates were probably around, probably even higher than 6%.
Not so much those interest rates, but in terms of the basis, your rate, interest rate, the basis.
So what this
is there a correlation between the low price of gold and the high basis rate?
I see what you're saying. You know what? Not as much as you might think. I think when you have higher interest rates, this does tend to go up, but again, it starts losing that connection when you go higher. And of course, when you have, the example I could give for silver in 2006, when the ETF launched, the silver ETF Barclays, the basis went negative into backwardation for a couple months. Everyone was accumulating silver, thinking that it's gonna, and it wasn't an interest rate thing. It was just a specific, market event. What we're talking about, though, in the final sort of solution, as it were, is that market event will be everyone seeking to buy spot and no one's buying spot. So you can care less what happens with the futures. Probably no one's really dealing in futures anyway, but the spot is really going to be sort of obviously shooting to the moon. Any other questions?
Is there a correlation between, or a relationship between the basis and the price? Are they completely independent or are they related? Because the professor has talked about the strategy of using the basis to time your purchases of, or your spot purchases of metal.
I think we will get more into that when we talk about the bimetallic arbitrage. That's one component of...
However, I think there's a justification for this question, because you don't have to do bimetallic arbitrage to use the basis as a signal for gold purchases or
Right.
silver purchases.
Right.
So perhaps let me sharpen this a little bit.
Okay.
Here we are in Australia. Where would you get your clues for the spot price if you want to suppose you live in Australia.
Okay.
Suppose you...
That's the Australians. Where do you guys get to?
Yeah.
Pico. Okay, but that's London. Really, that's the price in London.
Yes, no, but this is... No,
Okay,
you
that's
see,
the Perth Mint. Here we go.
The Perth Mint has a fixed price every day.
Yeah, just to answer that question, we, in the late 90s, we were approached by a guy who wanted to create a long gold fund and also a short mutual fund. And to investigate the short mutual fund and how the mechanics would work, he had to get all the data that we had on the lease rate, the cash rate, and the spot price. And then, because when he realised, so there's a contango and there's a potential for profit here. And I remember I dumped in all the data and he had a look at it and he came back and he said there was no relationship. He couldn't see any correlation. So I wouldn't think that you're going to find that there's this great secret magic trick that we've just all discovered, that there's this correlation between lease rates, interest rates, or the basis, and spot prices are going to give you this super clear trading.
Right, it does. Yeah, there's no,
exist.
and I've looked for a couple of years myself.
Yeah.
That's why there's no direct answer to that. There's no magic pill. I mean, if there was,
Yeah.
people have been doing this, and it would.
Well, I wouldn't be.
And there might. What I'm saying
I
is,
would
if
have
this
done a deal with the Treasury and be trading away right now.
if it was that simple, it'd be easy to discover it. So you really, this is, but I think that was.
Jeff, that's the second thing about the spot price is, and that's right. I mean, this is a sort of theoretical discussion. I mean, in the end, if you want to actually do this strategy, your price is going to be, well, where are you buying gold from? Spot to start with. Let's forget about how you do the futures. It's going to be the price that you're going to pay the person in front allocated. It's not going to be this or any other price. It's going to be the price you pay to get actual buy gold or to sell gold. So and that is going to be a little bit different to this sort of calculation. Now, on that, I just rang the treasurer and said, hey, if I got a great business opportunity because everyone wants to trade basis, technically we could do that. I mean, and what we would do is be doing it through forward. So instead of selling a futures, you're buying spot and selling a futures contract, you would buy spot and sell forward. And we could actually quote that and do that price. And we're not set up at the moment for that because we need a very robust treasury system. We're in the process of getting one, and that will be not in until July next year. But when I said to him, it's theoretically possible and he can quote a forward rate and you could do this strategy, but and his initial gut reaction is, well, considering the buy-sell spreads on both spot and the forward, he's not too sure there'd be in practical terms, at least at this stage, given where lease rates and interest rates are so low, that there's going to be a
today,
great,
of course,
massive trading opportunity.
We're near zero, though, so
Yeah.
of course. But when you're at 4%, I think you've got something to work with.
But what
again,
I'll
it
do
depends.
when we go back is I'll certainly investigate that a bit further, and since we'll all be on the same email, I can keep you in contact. And what I'll try and work with Tom is on getting a more robust spot and maybe forward price, because that's what we would be.
Did he mention what forward price that he's using? Was it the London?
Yeah, it'll be London. We'd all be based off London. Yeah.
Does the volatility of the Australian dollar at the moment ruin any chance of doing that?
Well, that's an interesting thing to investigate. I mean,
It dropped gained 2 cents in about 20 minutes this morning.
but you see, the beauty of this is, again, it doesn't matter what's happened to the price. It doesn't matter if it's an Aussie price. You're not trading the Australian price. This eliminates that because you're trading the difference.
Otherwise you're both trading both in Aussie rather than futures, which would be...
Right. If you're,
And as I said, because we would quote you an Australian forward price. So again, now what we'll do is probably in the meantime is track that and see whether there is a trading opportunity.
Right. And you then have to hedge your currency risk, right? Because the forward.
Yeah, or we'd just buy Australian, sell Australian gold.
Australia, Princeton.
But I know what you're trying. I know what you're trying to get at.
Can the basis be used to time your purchases of meat? As the professor has suggested.
Well, I think again
we can get into it
we haven't gotten to the part of the bimetallic arbitrage yet. I think it's possible, but I have not found a consistent tool that you can do, frequently enough that you would simply use the basis as sort of just by itself a trading mechanism. But there are other things, and I'm hoping in the next little while to get into that. You can compare the basis to other things, and maybe this guy wasn't really looking at enough different things. But when you start expanding your horizons, you start to see sort of almost a flow of metal through the markets. And if you can time the flow of metal, of course if you can get there ahead of time, you know which way things are going. But this is not sort of well, okay, the basis now went up to 4%. Oh, this indicates that you should be buying gold, because the basis could be at 4% when gold is going down, and it could be when it's going up, it could be when it's spiking down, it could be when it's spiking up. You have to combine that with other factors, not just that by itself.
Certainly confirms that I've found personally. There's almost no correlation.
Right, but there are some that, if you look carefully enough, for example, I think you were there when I explained that if you look at a certain type of spike, okay, and then it returns back to the level, it's almost like a failure, a market failure to sort of move the market.
Volatility.
A spike in the basis and then a return to the previous level, and it's maybe a day or two or whatever it is.
Yeah.
Typically, shortly thereafter, you see a major market move in the opposite direction in the price. Enough that I think that could potentially be a tool. Now, I haven't tested that back, 20, 30 years, but on a 3 years, I saw 5 or 6 episodes of this, like 8, 4 of those or whatever were. And see, these are major moves, so you don't care about if it's just a little bit. Who cares, But these are really, so that's what you're looking for. And so there some of that does exist, but again, you can't just be looking at. You have to really dig down into it a little bit. That's what I've been doing this for a couple of years, and again, like I said, if I had already figured this out, I'm not the kind of guy that wouldn't be happy just doing it myself and making a bunch of money. I wouldn't need to come here and be teaching anyone. And I'm not that generous either. So if I could do this myself, I'd rather just be home, sitting on my trunks and trading this. So this is an ongoing process. There are certainly things that you could use the basis, and I've actually done it myself. But this is not something I could sort of say, throw it out here, and without any sort of understanding of these the fundamentals, you could just figure this out. This is a learning process, and I don't expect that I'm probably you're probably like this far. I'm probably here, and you want to just keep increasing your knowledge. And the way I view it now is much more that it's added a totally new dimension to my analysis and the way that I trade. And I've actually seen it improve my trading. But not just because it's just a flat-out single signal that I don't combine with anything else. You combine it with other signals, you understand what the flow in the market is, and you try to put that all into perspective.
Tom, we all understand that you don't take your clues as far as the gold price is concerned from Australia, because you live in California. I live in Hungary, and I don't take my... But I would like to put myself in the position of a person who lives here.
Yeah.
And I would like to be able to suggest that there is a local basis here in Australia and how to calculate it. So I understand you have your own agenda which you'd like to go on with, but I'd like to book 10 minutes before we adjourn for lunch to go back to your question. Michael? Yeah, we want to go back to your question this session before we adjourn for lunch. So let Tom continue his exposition.
Great. Okay, excellent.
Tom, just a question. In our discussion during the tea break, you said that the basis had shrunk at the moment.
That's correct.
Right, so it's not 4%, it's what?
Yeah, I
1
mean,
or 2 or
currently,
something?
depending on how you calculate it, but if I just look at the forward rates, again, I don't know what's going on with the internet, I can't pull it up, but throughout this year, both gold and silver, the forward rates at the LBMA have been in that 3 to 4% range, with 4% being the absolute top, more typically 3, that kind of range. Starting in August, both rates for silver and gold started to drop, the forward rates.
Well, the point that I'm trying to make is I got the impression from our discussion that you're expecting it to fluctuate between that 2 and 4, right? And that's how
Typically.
and that's what we're saying. We trade that fluctuation.
Right, but that would be one method. But keep in mind that
just hear me out.
okay.
considering what's going on and the fact that we are so close to zero, have you considered the fact that maybe this is a time when it's actually going to tip over into backwardation? This may be it.
You know, it could be, but as I said, it's not unique that gold or silver might be in backwardation for a period of time and then pull back out of it. So this is really, because it's an unprecedented situation, there is
As
really
we
no
say,
template.
This situation is unique.
But there's no
It's not
template
unique
for going back and saying, oh, this is like 1980 or it's like 1933 or any other date. I think what you have to do is you have to fundamentally understand what the basis means and what it says, look at what the market factors are, and try to determine, is this going negative or basis going into backwardation, that indicator, and is it continuing to stay in backwardation, what's happening with physical, or people buying the ETF, what's going on at the retail level, what's going on at the wholesale level. You have to take these all into account. So I can't say that just because the basis is going to zero or negative at this point that this is like, okay, this is it, because it has to be a permanent backwardation. And the indication of that is that it's not just today that people are not willing to sell gold, they're not going to be willing to sell it when gold's at $2,000. And I could say that there are probably a lot of people that today may be willing to sell gold at $2,000 still. So my personal belief is that this is not it. But this is just my studying of it. Maybe some other people have a different opinion, and that's what it is. This is not concrete enough to say this is definitely it. But you're right. From an abstract point that's at zero, it could certainly be. But I look at other factors too. I'm not getting an indication. My sort of analysis says 12 to 18 months. If we're in backwardation and we've stayed at this level and even gone negative periodically and back and forth, and we're still there in 12 to 18 months, let's talk.
About what?
I don't need to have everything so you can talk to me about what you want to act about. Just act. I don't need to act. I'm already as prepared as I need to be. Okay, any other questions?
Is there a constant, have you discovered any differences between different periods of the basis? Say, for example, on each 3 months or 4 months period at all? Say, for example, is the basis between, say, December to April the same as the April to June or July?
There's a shrink. Yeah, there's not. I haven't really myself, and this is an interesting thing, chart each of the futures, right, and see where they go. That's not actually something I've done myself, other than to try to establish this sort of average price that I talked about before. I've averaged all of them together to sort of come up with a price, but I haven't compared each of those to each other. It really is a hard thing to do, because the further out you go, the less volume there is, and the more, therefore, the price is not necessarily indicative of a liquid market, and the less liquid a market is, the more likely that the price is not going to be
How
a
about
very good price.
historically? Going backwards?
I have not done an analysis where I took each set of
Something
futures
for you to
prices
do, would
and
it?
determined maybe there's a strategy trading these spreads. The way I've looked at spreads was always the nearest futures,
Yes,
okay,
I
or the
know.
one that is coming into expiration versus one out a few months. Because if you're going to have a massive shrinking, typically it happens, in that. Not the further out ones can also shrink, but especially the spread order, it's pretty hard to enter a spread order for something that's 6 months out and then something that's 12 months out. The stuff that's 12 months out, there might only be 200 contracts total.
I hear what you're saying.
And the market's 200,000 contracts. So you may never fill on that, even if it's, even if you hit that limit or whatever, or things should be at that price based on, what your math says. Someone may not be there, to sell at that price or buy at that price. It might be a valid tool, because who knows? Maybe there's something there. There could be something there. I got a lot of this. If anyone else to do it too.
I have something to add here to
Okay.
this point, which might be important. You admitted you don't know for sure. I admit I don't know for sure, but it is something worth watching. The basis, the concept of the basis can be refined by taking into account all the spreads. So the differences between various future prices, always subtracting the nearer from the more distant future price. Then you have not just one number, but you have actually a landscape of numbers. I don't call it basis, but I would like to give a name to the picture. This is the big picture of which the basis is at the center. And I would like to call it, I'm improvising now, calling it a web. Think of a cobweb, okay? So the cobweb serves two purposes for the spider. On the one hand, it catches the victim, but it's also a communication system, because if a fly, say, approaches the far corner of the web, this gives signals to the spider, alerting the spider to be ready to go there and catch the victim. So in the same way, I'm suggesting it to you that we have in the web, or basis web, or web basis, I don't know, I leave it to the linguists to find the right word, but let's just call it web for simplicity. This is a refinement of the idea of the basis. It catches a much larger, it casts its net much wider, catches information from a wider pool. And this may be important and critical, especially at crisis time like we have now. Normally, when markets are calm, the basis is sufficient. It gives you the necessary information. But when there is a crisis, then you want the big picture. And the big picture is this web, which includes not just the basis, the difference between the nearby future and the cash price, but all the future spreads.
All the spreads, yeah.
And then, well, this is something we have to work on and develop the theory, how we can utilize this type of information. So I think
Great,
this...
more work. Looking forward to it.
I think...
But I actually have something to add to that too.
If we are forward-looking, we should take this into... I remember when I first met Tom, we had a little discussion on the concept of a basis, and Tom was inclined to cast his net wider, and I said, no, let's focus it. And now I've come around and say, well, this was a very wise and forward-looking approach.
Yeah.
But still, we want to be clear. Basis is a definite number, whereas the spreads are, and we just have to make up the big picture. Okay.
Yeah, the one thing I would add to that is the idea of a web is, I think I've mentioned this, that I've become aware of the importance of comparing different markets to each other. And this is not just the different futures, but for example, the ETF markets have become very significant in the amount of dollar volume of trading of gold and silver that occurs. Now, of course, most of the ETF trading is just people trading back and forth. It doesn't translate to the physical market, but it is an indication. So this would be another extension of the web that you look at the ETF, and this is what.
And maybe Tocom.
Certainly could be, right. I mean, I think the more price information you have, maybe there's some limits to the computing power you have. Some people can maybe help with that. Well, yeah, but there may be ways around that, meaning, you may not be able to take a four-dimensional view of things, but, a computer perhaps can. But incorporating the price feeds really from different markets, because the basis is not only in time, it's also in place. In the grain, we didn't mention too much, but in grains, what it turns out, maybe I did mention it, that part of the basis is the physical location of it. It's not just that it's deliverable in 6 to 12 months, but that it's deliverable in a different location, and that there's a different price for it in that location because of where it is. So there's a different price, obviously, for gold in London, in New York, not just because it's deliverable at a certain time, period of time, but just because of how much that local demand is for taking physical delivery versus what that physical supply is. So I think that is actually something I've kind of been doing, but not really. I guess I didn't think about it in terms of including more futures data, but I think this is actually right, that it may.
Plenty for you to do.
Yeah, thanks. Okay, let's go for it.
We appreciate you sharing your trading experience. Let's say I want to do trading the basis now.
Okay.
The practical problem, I think I understand the first part. When I want to buy the basis, I buy the spot and then I sell the futures simultaneously. When I buy the spot, let's say 710, do I buy physical or do I buy in the future market, put 10% and then the margin, and then I get one contract 100 ounce?
Yeah. So in this case, if the December is close enough that in fact it acts as like kind of a proxy for the spot, those two are pretty close together, but there's a futures contract further out at some point that has a significant contango that you can compare to a historical number that is relatively high, you could affect simply use this is more of a spread, not the basis because it's between two futures, but this futures can substitute. Now this is just for trading. This is not for keeping forever or anything like this. This would be for for a very short period of time, but certainly you can. Yeah.
No, my question is, as the professor said, okay, when you want to buy basis, you buy spot, then you sell future. Okay, I want to do it now. Let's say December is 1 month or 2 months away.
Okay.
When I buy 710 cash, do you, from your experience, do you enter a contract 100 ounce without taking physical, just put 10% and hold a contract, long position? Hold a long position and then you sell short?
That would be a spread, not.
Right. So what you're saying is you can take the December 08 and hold the long position in this instead of buying
you take
physical.
long in spot price?
But if you take a long in spot price, you're paying cash and for 100% and receiving, right?
Receiving.
The 100 ounces.
Yeah.
So then to enter into a basis trade, you would short the December.
Short the December, yes.
Correct.
At the
And
same
you would
time.
have to put up some. You're right. You would have to put up some margin, 5 to 10%, whatever
Yes.
it is. And then in effect, then you would have
Yeah.
the basis trade.
So when the basis come down, let's say from 4% drop, I will sell the
The
basis.
cell phone is going.
Sorry. When you buy the basis now, so we unwind, you sell the basis. So you unwind your position. You sell your spot, then you buy your future.
Correct. I'm sorry. Yeah. Exactly.
My question is only on the cash. Do you buy in full physical or do you put 10% and hold a contract?
It's not cash.
I would buy if you're one contract here's 100 ounces.
Yes.
You can trade the basis. You want to buy 100 ounces of physical because otherwise you don't have a full offset. The margin itself is just to make sure that if you're in the hole, that the contract can still be liquidated.
So you actually
Exchange
buy
for
physical
loss.
for the cap spot. You
Full,
pay in
full
full.
amount. That's right. You pay in full amount. But again, if you substitute the spot for December, you could buy the December. It's actually interesting that you could buy this December 2008 and let's say sell the June 2009, and the margin on that total is $250.
Yeah.
Yet there's still the potential that this could get really upside down and you could make thousands of dollars. And the most that these would probably move apart is a few $100s. So you can essentially do that by, and then you don't have to put out 100% here. That's the way I do it. Because I just don't have enough money committed that I'd actually go buy 100 ounces of gold and trade the futures. But many of you probably would have that have those needs. So
Where's the cell phone? Is this the line coming? Where's that coming from?
Where's that coming
I think it's next door.
The door?
Next door, I think.
Oh, this?
someplace in this someplace in this area.
December contract expires. Oh, there it is. I have a little
You exit you exit the basis, on the expiration date. So you have this trade has 16 days on it. Okay. So you would say that in 16 days this would have to make the move or you exit it. Now you may it may be that you don't lose anything or it breaks even or you lose a little bit. So it's like anything else, but Then when you're, this December contract's up, the next contract's in February. It may be a little bit too far apart now to say, well, I'm going to buy the February and then sell the October, whatever, the next December. You want to be, I think, a little bit closer. Again, the futures is not going to, this backwardation phenomenon happens typically pretty close to expiration when it turns big. So if you're a few months out, your profit potential is not that large. It may not be worth the risk of doing this as opposed to something else.
Would you use the volume indicator to dictate which particular futures you would go with?
Yes. So the next sort of step, if we took this further, would be that if you are in cash and then you're looking at the next month of the futures, you wouldn't want to be short this one when the volume or the open interest, then this really dives down, pretty low. And it's actually interesting that if you chart when futures roll, this is actually an indicator itself. It's corollary to the basis, but it's a different date each month. The longer it takes for the volume and the open interest in the futures contract to go to the next contract month, the more there is people standing for physical delivery on that futures contract, and therefore the more supportive, all things being equal, the price will be, and the more likely that it's going to be spiking or at least going up. I mean, for example, in 1979-80, there were times when the most active futures contract was already like 5 or 10 days in delivery, meaning that the December contract would still be the active contract on December 10th or December 9th or something like that. I mean, it's unimaginable today. Typically now it's like 10, 15 days before, because people want to get out, and they roll to the next one. Most people don't hold contracts to delivery, and so they roll it enough in advance so they can take advantage of the liquidity. It's a race out the door. If you wait too long, then, especially if you have a large position, you don't want to be, like there's 5,000 contracts left and you have 2,500 of them. It's not going to be easy to get out. So there's sort of a race for the door, and everyone kind of jockeys for position in a way. I'm not physically, but people see the open interest dropping, so they, based on their position sizes, they want to get out and roll to the next month. But if there's a lot of contracts being held for delivery, there's not that jockeying going on. People will literally will be sitting on these contracts. And there's been two examples actually this year where this kind of trade would have made literally a fortune. Unfortunately, it wasn't in gold or silver, but in was it March wheat or April wheat? The spring wheat crop at one point went into a backwardation of $5 per bushel per contract, and each dollar is worth $5,000. So it's $25,000. The cost of the margin on that contract would have been $125.
Huh.
So had you been smart enough to hold that contract and say, well, I think there's something going on in wheat, I see that they're not option, open interest is not rolling, I'm going to take a spread on this, I'm going to buy the March, sell the July, or whatever it is, and hold it until as long as I can. On that expiration date, the last notice date, you would have been up $25,000 for a risk of 125 with literally no downside.
What caused this?
They're still trying to figure it out.
Well, you still don't.
Still trying to. Some people say that part of it was the terminals. The grain terminals are controlled by just a few companies, so there's only a certain amount that goes through there. So there was a dislocation between where the demand was being placed. This is a Kansas City. This is a spring wheat, so it's a Kansas City contract, and so but Chicago's where the main grain terminal is. So there was some interplay between things. No one really knows. This was not a monetary or economic phenomenon, but it's capable of happening. And of course, in gold and silver, I mean, we know that this is capable of happening. So it just shows, that just in relatively normal times, you can generate very, very large profits off of something like this. In fact, I know I've got a few friends that ever since that happened, we're just copycats. Okay, every time wheat now is going to expiration, they just buy the same spread. And they've pretty much just kind of broken even or whatever, but, the idea is that if it's happened once, if you keep doing it, you only need it to happen, because you could buy 200 contracts. for very little, and 200 times 25,000. I mean, it's not that much.
The spread margin is low. Spread margin is low.
Yeah, it's very, very low, right?
Very low.
And sometimes it does increase, but typically it's not adjusted in the same manner that it is on the outright contract. The other one I believe was in oil. I think this is very recent. This was September or October oil. I think went into, and I don't know the exact number, but I think something like $10, and each dollar, oil is 1,000 barrels, so $1,000. So that's $10,000 per contract, and that was I forgot what the months it was, but it was literally just between the expiring month, whether it was October, and the next month, which is the November month. And this was in a period, I think, when prices were already sort of coming down. So it's not only a phenomenon that it's really strong markets, everyone's trying to take delivery. These things happen just because, this might have just been physically what I was saying, is people were jockeying to get out and someone got caught with a very large position. In fact, I think that's part of the speculation. They just couldn't get out, so they had to pay. They weren't there to, they didn't have oil to deliver, so they had to pay, it's kind of a squeeze, as it were. So these kind of things are certainly within the realm of possibility.
What's the minimum size of a futures contract, and what's the minimum amount you could pay as a deposit? 10%, 5%?
The minimum sizes of futures are called the mini futures, and gold is 33 ounces.
1 kilogram.
Yeah, in effect, right? Yeah. And that's traded on the Globex Chicago CME, and that has a physical delivery mechanism too. So if someone has a large position where they have spot, you literally would want to be buying the gold and storing it at a warehouse that you would be able to use that certificate to make good on having to deliver if you're actually delivering. And in silver, it's say 1,000 ounces, and they also have that on the CME through Globex. But the standard contract, of course, are 5,000 ounces for silver and 100 ounces for gold. So that if you're really serious about this, that's where really the more liquidity is. So you're much more likely, if you're trading, basically you're only talking about a few percentages here, that's probably more likely where, you'd actually be able to make profit, because the chances of slippage are pretty significant. You'd never do these trades, for example, as a market order, because especially in a spread, you're out further in the futures, the bids aren't as tight there. So you can end up looking at your chart, oh my God, this is, I literally have, made $2,000, you're in a market order, you've actually lost money because you were filled so far away from the last price that was quoted. So you have to enter these as limit orders on both sides. You put one in on the one side, if the basic gets big enough, I buy, and if they get small enough, I sell. And you enter those ahead of time, and you just let it work its magic. Any other questions?
Sorry, the second part of that, what's the minimum amount you can, you said you can put up 10%,
Oh, the margin.
you don't have to put the whole lot up?
The margin is not the percentage, it's specified by the exchange. It's a formula based on the 2 standard deviations from the daily volatility. So it changes over time. Right now I think it's $8,100 on silver and $6,000 something on gold per contract. So it's pretty low, but when silver was at $20 it was actually less. So there are times when you can actually have more leverage, and others when you have less. And like yesterday I think I gave the example of when things get out of control, of course, this kind of thing can backfire because the exchange could, for example, require 100%, or in the case of palladium was 120%. You're required to put up 120% of the price. So there's no point to speculate on the futures at that point. You might as well just speculate on the physical. It actually costs you less to buy the physical than to buy the futures. And that's a possibility in the for gold and silver. That could be one mechanism that would be used, for example, if there's this delivery default that everyone's been talking about for December, which I'm ready to be proven wrong, I suppose, but I just don't see how it's possible. But I think it is possible in months like March, April, May, some of these off months. And in fact, in 2004, there were actually some problems in silver in the March and May contracts. But like I said, the exchange could increase these margins and force people out of the market. Any questions?
Tom, just following on that, it seems that the basis could be an early warning sign that they're going to raise the margin on you, because that's one of the biggest problems with future traders, the thought that they could raise the margin just at your most critical moment. So do you see the basis as possible early warning for the margin change?
I mean, it could be certainly, you know, I think the people that are speculating that there's going to be a delivery default in the December contracts, you know, they have some inputs that they're not just taking this out of the air. I mean, there's strong retail demand, you know, there's big price discrepancies, but most importantly, the forward rates have been dropping, and if you're calculating the basis, that's been dropping. These are signs that there is incipient physical demand, not manifested in price necessarily, but manifested in the balance between you know, the available supply and the spot demand. And in fact, we've seen that prices have dropped, but the thing about the basis is, again, it's completely independent of price. But the resolution to get the two things back into equilibrium is typically a very violent event that happens over the course of several days. For example, the wheat and oil example, as I gave earlier, there was some imbalance and there's some discrepancy in that market that was obviously not easily detectable, as it may be here, but the adjustment was literally over a couple of days, and it created an extreme situation of backwardation of many dollars. I mean, and I certainly could see that happening. I mean, the gold and silver market, in some ways, have the potential because of the number of individuals. It's not like any of us here are really going to be, you know, professional wheat traders, but all of us probably own some gold and can probably do aspects of a strategy like this, and then you multiply that by, you know, everyone else. You know, it doesn't take much individuals to be involved in this to where it gets completely out of whack.
Tom?
In the event of a delivery default, for example, in the silver December contracts, what would be the likely events? Say, one is that they could raise the margin, but if they didn't raise the margin, obviously the prices for December would go up tremendously, right? Is that right?
I mean, yes, that's true if there is not enough silver to be delivered against what the demand is.
Yeah.
The default itself, by definition, is I suppose there's two types of default. One would be a delivery default.
Yeah.
There's not enough to deliver on, and two would be there was such a fast move in prices over such a small period of time that margins, because at some point the markets just get frozen. You got to remember this. In futures, you know, we haven't had this for a period, but you actually could have limit ups. Now in gold, they say, look, you know, it's you know, if it goes like $50, then you just close the market for 15 minutes. But that doesn't mean that they can't change that in order to stop you know, something from happening. So you might actually have limit up days for several days, and people get so turned upside down that they've literally lost everything. They can't make their margin calls, and if that happens across enough people, of course the exchange is responsible for making up losses that people are not willing to pay in. So the exchange may actually go bankrupt. It has money set aside, but it's very unusual that you would have a situation where it would have to, if people are doing their jobs, and of course the brokers get all sorts of penalties for not maintaining these, you know, margin calls on time. But if prices are moving fast enough, certainly you can have a situation where a bunch of people all of a sudden are bankrupt, cannot meet their obligations under their contract, and it's so large that the exchange itself is bankrupted. So it's two different types of default. The delivery default is easy to deal with from the exchange's perspective, because it's written into their rules as what they can do, and they can do almost anything. I don't know why you even call them rules. Right? The rules typically say it assumes a restriction. Well, right.
Strictly speaking, it's the default of the clearinghouse. It's not the exchange, which is really just giving the facilities. It's the clearinghouse, which is an association of the biggest brokers active in that particular.
Right. So, I mean, if you really got into the nitty-gritty, you're right. I mean, the exchange itself does not what makes up the losses of an individual trader. It's the clearinghouse, which is.
Yeah, but it's important, as you point out, that there are two centers of great risk. One is the default of the shorts, which is outside of the exchange, and then the default of the clearinghouse, which is so. These are the two things to watch.
Right.
Yeah.
Right.
Yeah.
And I don't know, even when they speak about December, if people really understand which one that they're talking about. I think in general people are saying that there's going to be so much demand because like guys like this Jason Hommel and Jim Poplova and some other people on the internet are saying, oh, everyone should, hey, we've already done everything we can with the retail, you can't buy, so if you're really buying, go buy a contract, stand for delivery on the futures. They're thinking that there's enough people out there that are heeding this advice, or there's enough people that they know is doing this, that literally there's more people that want to take delivery than there are people that are willing to, just because there's 130 million ounces of silver that is sitting in the COMEX warehouse, that only a small fraction at any one time is available at almost any price to be delivered upon. Most of it is actually not even sitting in what's called registered form, which has a warehouse certificate ready to be issued against it. Most of it is called eligible silver, which means that someone has deposited the silver in the warehouse not for the purpose of using it to trade the basis or for futures contracts. They just happen to have silver that qualifies for being traded, but it hasn't been designated as having been traded. So that's when you look at those fractions, it's actually a pretty small amount that is really designated for futures activity, and even of that, only a fraction of that has ever taken delivery of. So it's not actually a completely crazy concept that a few Jason Hommels put together could actually make a run, as it were, on on the available silver in the COMEX. I just don't think December is the month that you would want to be even doing it. Any other questions?
All right. I guess there's time for. Oh, there's another question here. Yes, go, Lawrence.
Rudely interrupted you all with a phone call on Saturday. I was going to ask, could you play the basis, say, own 100 ounces of gold, and instead of buying the physical from the market, you essentially bought it from yourself, okay, and then entered into the selling half of the basis trade by going into the futures market. Then you wanted to clear, you canceled out your futures contract and bought the opposite one and bought the gold back for yourself, thus avoiding half of the transaction costs.
Meaning this would be gold that you already own,
Yeah.
that you would use? Yeah, of course, okay, right. But the problem with that is if you ever did have a situation where you had to deliver that gold, there's expense and time with which you can do it. In fact, what it turns out is that if you hold the contract too long for whatever reason, you essentially get forced out and have to make maybe a cash settlement, and you don't have the cash. So then you have to have cash. So if you were to do that, I would say make sure the margin that you hold in your futures account is more than the minimum that the exchange requires, because you may have to settle. You might have to do what's called an exchange for physicals. So you actually obtain gold that's sitting in the warehouse, because that's the only type that you could actually use to make a delivery if something truly goes wrong, and everyone's thinking, oh, it's going this way, backwardation, boom, it reverses. Because I'm not saying that this is a totally risk-free proposition. With everything else, there's probabilities, but the probabilities are so skewed on one side. I mean, why in gold and silver? I mean, why would you ever sell the basis? Maybe that's a question for the professor. Would you sell the basis in gold and silver ever? What would there be a scenario?
Well, it depends whether you are trading or investing. And under investing, I also include those like myself who is motivated by an insurance aspect rather than an investment aspect. If you are trading, definitely you have to be prepared to buy and sell.
Well, meaning sell. Well, because you said you can sell first and then buy later, but you reverse the risk profile, didn't you, when you sell first?
Well, you have an inventory of long basis positions, okay, and sometimes you add to it, sometimes you reduce the size depending on the variation of basis. You see, the point of having an inventory is that if the basis doesn't move immediately in your direction, you still have some ammunition that you can add to it, and then vice versa. If the basis is moving in your direction, you don't want to take all the profits at the first fall of the basis, but you sell a smaller portion of your inventory, and then further fall will trigger another sale and so on. And you don't want to run out of
But
ammunition.
you don't really ever want to be like us net negative.
No.
No, that's what I was asking. So you don't want to be
No.
net. You don't see a circumstance where you would want to be net negative.
No, not at
basis
that.
in gold and
We are
silver. Not in this too far along
late,
in the process.
too
Yeah.
far along.
With this too far, if we were talking 2 months ago when truly we were at 4%, some of you actually could have done, gone from here and made some money, because you would have said, oh look, it's right on 4%, like Tom was saying. Look, I look at the market, it's 4%. Let me buy this. Okay, let me buy this spread, and you would have made, something on the order of 3,000 or 4,000 per contract in silver, and
No more
about
questions.
2,000, 2,200
Another
gold.
question?
That was 2 months ago, though. So, it's hard to say now, okay, you can go tomorrow and do a trade based on the basis because this opportunity is not available right now. But it could be in 2 months. So it's, that's also an important thing here that, well, as I was planning for this, I was like, okay, great, this is an example. I could actually give a particular example here in the session, and we can follow it to see if it made money or not. But it's that was 2 months ago. So, any other questions?
Well, we
And then
can't.
maybe we'll do a 10-minute.
We have a 10-minute one.
Yeah, you have the 10-minute
Yeah.
section. So why don't we do that?
Yeah.
Okay. I'd like to make it as concrete as possible. So suppose I decided to move to Australia, and I would like to use my financial resources to trade the basis. I'm a person of modest means, possibly a pensioner, but I do have an income, and I would like to follow the principles which we are developing here in practice. So it's very practical. The first question is, which city of Australia would I pick as my residence? Now, yesterday I got advice from Loránt, who suggested that Brisbane is the most wonderful place, the best climate. You don't have to have heating system or air conditioning, etc. Today Judy told me that Brisbane sports the biggest coin shop in
No, it's a sort of a reputable dealer, and then his brand is small.
Okay. So it sounds to me that Brisbane is... Now perhaps somebody in the audience could answer this question. If I phone up this particular principal dealer in Brisbane and ask him to quote as a bid price and an ask price on a certain coin, which is perhaps the most current bullion coin in Australia, what would it be? Would it be...
One is kangaroo.
Okay. Would he be able to give me, or would he be willing to give me a quote? Both bid and ask?
Yes.
He would.
Yes.
And what delivery date would he be likely to?
As long as the money is in his bank.
Oh, well, let's assume that I have enough money in his bank.
Oh, if you just go there, if you give him cash, he'll give you the coin.
He would.
Yes.
Now, could this do you anticipate that this could change tomorrow, and he would say, no, we take 1 week for delivery?
They usually don't sell you at all. They say, we have nothing, call back next week.
No, not my experience.
Judy, look, listen. They're telling you, call back. Judy's in the shop. She's a wonderful shop.
Or maybe you could try a female voice.
No, actually, when you're migrating, I would not guarantee it. But I think within a week or so, I think you're pretty safe to go there and put your money, you'll get your coin. That's my understanding. I mean, it would have changed. I mean, I haven't dealt with him for about a month or so. But you can, from the web, you can ring him up now if you're really interested, just for fun.
These coins are minted in Perth?
Yes, they are.
And I'm assuming that he is getting his supply.
He already got his supply from the mint. I mean, Braun was telling us some of the coin dealer has bought 5,000 or how much worth. sitting in their wallet.
Okay, all right. Now this sounds extremely good to me as a newcomer to Australia, because it's 1,000% better than in the United States, and it's several 100% better than, for example, in Germany, which is a very rich country with a tradition of gold investors, and therefore I would say you are very well placed. The next thing you want to do is you build up a little bit of history for the basis. So for that purposes, I would make arrangements with that dealer, telling him that I will call him daily for bid and ask prices on the same coin. And if there's any change in delivery policy, he would tell me that. Okay? So then I would set up a spreadsheet day by day, and if the market is very volatile, perhaps several times a day, I want bid and ask quotes. So all this information I would collect in my spreadsheet. Okay? So this is my spot leg. You see, when we talk about bases, buying bases, you have to have a long leg and a short leg. So I enter these. I'm not buying yet. I'm just collecting information to have a history. So, all right. And then for the short leg, I could use COMEX. Now it's a matter of would you use settlement price or a certain price during the trading hours?
Well, the thing is you can get, live data costs $50 a month through a number of different services. So
you can get it free with 15.
Delayed, 20-minute delayed.
Well, that doesn't matter. For the purposes.
Oh, for this, okay, you can get it almost anywhere 20-minute delayed. Yeah.
Yeah, but my question to you is, would you prefer the settlement price for making the history chart, or would you just say, okay, intraday trading at a certain
intraday trading? Because if you call 2 or 3 times a day, certainly you'd want intraday. But I think you probably, because you could literally be on the internet when you're making a call and see what the price is at that time, and then chart it from what your phone call is.
Okay. So at the same time, you try to call your dealer at a time when COMEX is in session.
The point is, there is a fluctuation in Australian dollars. So you will have to take in account of the the fluctuation of the currency. So it's difficult to do it.
No, I think the dealer should be able to give you price quotation in US dollars for the time being.
No, they always on the spot price is in Australian dollars. And the thing is, with this spread, his profit margin is crucial.
Can I just ask just a general question of the forum? This facility that trades on the Australian ASX, the gold, GOLD, it trades, what is it? Is it 1/10 of an ounce? And does that give a direct relation to
the problem is that that's not exactly 1/10 of an ounce, because it's got a declining balance, because it's how it covers the storage fees.
Oh, okay.
It's got the EZAUWBA. That's a code on the.
I just wondered if you could use that.
I suppose you can use that to trade. Yeah.
If you want spot prices, just go to the Perth Mint website, because I've got every day's average price in there going back to 91. And that's the actual average of the intraday prices for Perth Mint, published in the shop on which real different deals are done. There is now a live page which has the AUD and USD bid and ask spread. That is the basis on which the shop physical prices for coins and bars are traded. And that may change 8 times during a day. It's massively frequent, but that is effectively the Australian intraday price, which you could use, and really the dealers would probably look at what the Perth Mint's quoting as its bid and ask spread.
Very much so, yeah.
And based off that. So I would suggest that's probably the one to use in Australia. It's just go to the Perth Mint.
There's another one, ABC, Australian Bullion Company, and they can just go on there and get the daily.
Is that
email to you every day as well,
I mean, also kick games.
typical US.
Yeah, but
But it doesn't give you for the price of what you can buy. I mean, you can't buy at that price. Is a problem. Only a large, full, dealer can buy at that price. You want to get a price that you can actually buy at. That's at the moment when you're taking that temperature of the market.
Oh, time is limited, so let me get on with this. All right, this is a coordinate system. The horizontal axis is time, let's say days. And the vertical axis is the basis which we now decided to calculate on the basis of the Brisbane dealer's quote. Okay, you can take the average of the bid and the ask price. And that's the long leg, and the short leg is the COMEX. You try to get from Kitco or whatever sources, this is no problem. Free quotations are available. If 20-minute delay, that's no problem. Okay, and then you chart it, the basis. Now, what I want you to show on your chart is the carrying charge. Because we know it's an upper limit for the basis. The basis we can take for granted would never get above that. And the closer you are to that level, the better your deal is to buy, to time your purchases of the coins. And if there's a spike, then you might want to buy more coins because you get an extremely good deal. Other than that, I would expect the basis would have a trend of falling with spikes and troughs. Okay? If you are accumulating, you have a strategy of accumulation. In other words, you never sell, you just buy. Now you don't buy on payday, but you wait after pay. You have the cash sitting in the account in the same bank where the Brisbane dealer has it. So if you have a spike, you give him a buy order.
I see.
And after next payday, you do the same. So the timing is guided by your chart. This is your personal basis chart, okay, which is different from somebody else's who is buying his coins in Germany or in the US or wherever. And I think what I hear from you, you have a great advantage over people who live in the United States and Germany.
We can't buy any.
No, I think you can buy with a very high premium.
You're right.
Which means the basis is that much lower.
Yeah.
But anyhow, this is a starter, and you can paper trade for any length of time when you build up confidence, and then you can start with real money and get the coins.
By then, I think he probably sold out.
No, I actually, the same remark. I don't think they would get sold out. For good customers, they would say, we deliver at a high premium. We don't want to scare you, but be prepared.
No, they pick up too from you if you really now to want to trade it. Actually, you can if enough margin in it, because they're trying to coax you to sell them back, and they make the profit.
Yeah. Okay, there was a question there.
When you were saying the other side of the leg is the COMEX price, is that the futures one? Because the basis is the difference between the spot price and the futures price. So the spot price you're getting from the dealer, and the COMEX price is your futures price, is it?
Yes. That's COMEX price is the futures.
So it's going to be the nearest futures price.
Nearest future.
So it's going to
Yeah, the nearest future would
Near,
work,
yeah.
as long as it's the one with the
Yeah,
most volume.
but you have to be consistent, you see. I mean, once you started working with that particular month, you change only after this month moved into or dropped from the board, and then it's the next one.
That's right, that's right.
Yeah.
And you'd still want to standardize. You still want to divide by the days and
Yes.
create an annualized
Oh, that's
rate.
right.
So you wouldn't just
That's
do a
right.
straight price, you'd have to still do
Yeah,
that
there's
calculation
a little
that I went over
calculation
before. Right, yeah.
involved.
Yeah.
But the important point I'm making is that you are using the local, because that's critical, that you should be able to get the gold coin when you get the signal. And that is crucial here, that you have a business relationship with the dealer. He knows you, and in person. That's why you have to live in Brisbane, and you go and make friends with him and so on. And you can be sure that he will always give you the best treatment.
Well, you can do the same thing with Perth Mint. I mean, I have an account with Perth Mint. I can just ring up.
I take one more question, and then I will ask Michael to say if this more or less as a good start to, because we all started with your question, right? Okay.
Just on the comment there about the buy and sell, you could do that with unallocated gold.
Yes, you can.
ABC, for instance, it's $8 above spot to buy allocated gold. So if you bought it when it's in the peak and then sold it on the drop,
Yeah.
would that be similar to doing what you're saying?
Yeah, true.
Could you?
Because I think you understand this.
You can buy allocated or also unallocated gold from bronze in Perth Mint.
Unallocated gold from the mint.
And you can do that on the basis. And you can buy and sell because you already have the gold in their mint. And they're happy to sell it, and you can trade the basis that way on a theoretical basis.
But that's not a selling strategy, though. We should maybe specify that this is an accumulation strategy.
That's an accumulation.
No, even so, you can still do that on
Not going
theory.
to trade the basis like this, the way Professor is saying, though, that you would want to sell. This is gold you don't
You
want to
can
ever
still
sell.
use that much better than trading, of course.
Right.
No, but if you consider trading, in other words, not just accumulation, I would suggest that you set up two accounts for yourself. One, an accumulation
Accumulate,
account,
and then another trading.
and another a trading account, which could go as low to zero, and build it up again. But don't mix the two, because that could be dangerous, especially at times like this when a crisis situation could develop. Okay. Concerning unallocated gold, I would like to be sure that the Perth Mint doesn't do naked selling.
Not according to Braun.
In that case, I would consider unallocated gold.
Well, I would add that only if the premium on the physical gold coins that you could buy is so high. But I'm not trying to but really, I mean, if
physical, buy unallocated, allocated, whatever.
Unallocated is just
I mean, what I would say is that for us in Australia, probably maybe it's a team exercise that we need to do. Is that what we have? Is we have the Perth Mint website with a spot price. We have the ABC website quoting a price. We have the GOLD, and we have our warrant on the ASX, which also intraday live price data. So those are all Australian gold prices for various things. I think if you charted all those intraday, you would probably get your spot price, your real underlying spot price. Because all of those instruments are the same. You know, the GOLD product is a gold.
But just to be clear here, this is an accumulation strategy, and that you would be making purchases for your own account for a long-term core holding using this methodology. And instead of trying to time the price and say, well, now there's a spike down in the price and this is it, and I'm going to base my purchase because it's a low price, or I think it's a low price. You're not making the timing decision based on the price. You're making it on the basis that the basis is closest to its largest, that 4%. Remember I was talking about 4%?
Is you're using the basis. Can you use the basis to buy and sell unallocated gold?
Yes.
Any gold. Any gold. So unallocated because then you have such a much smaller spread.
I would
You
s-
could
Yeah,
use that to do that.
not raw like this, because we've had that question a number of times today, and if that could be done, then we'd all be millionaires after this session. No, the answer is no, because the data does not support that.
Okay, okay.
We're on.
I will start in the afternoon by going back to Michael. Thank heaven for Australia. Thank heaven for Perth. Thank heaven for Brisbane.